The final check has been cashed. The repair shop has done impeccable work. Your car looks, drives, and feels exactly as it did before the accident. The insurance company has fulfilled its duty. The case is closed. But a secret has been etched into your car's permanent record. A digital scar no polish can remove. And because of it, your vehicle is now worth thousands less in the marketplace. This loss is real, financial, and immediate. It is called diminished value. And in almost every state, for almost every accident that wasn't your fault, you are legally entitled to be compensated for it. Most people drive away from this money forever. This is how you turn around, go back, and claim it. The diminished value loophole. The ghost in the machine understanding the hidden loss. Diminished value is not the cost of repair. That is property damage. Diminished value is the lingering economic stigma. It is the measurable difference between what your car was worth before the accident and what it is worth after a perfect repair. It exists for one simple reason. The used car market is ruthlessly efficient and deeply suspicious. There are three types of diminished value. Repair-related diminished value. Loss from shoddy workmanship, bad paint match, poor alignment. This is a claim against the repair shop. Immediate diminished value. The loss in value the moment after the crash but before the repair. This is theoretical and rarely claimed. The insurance system is designed to make you physically whole to return your property to its pre-accident function. It is not inherently designed to make you economically whole. The payment for diminished value is a separate, parallel claim. It is often referred to as the third leg of an accident claim. First, your bodily injury. Second, the property damage. Third, the diminished value. Most people never realize the third leg exists. Act 2, the legal ground why you are owed this money. This is not a loophole in the sense of a trick. It is a legal principle rooted in centuries of common law. The concept of indemnity. To indemnify someone means to restore them to the financial position they occupied before a loss. If your car is worth $5,000 less the moment you drive it off the repair lot, you have not been fully indemnified. The landmark case that blew this door open for modern policyholders occurred in Georgia in 2001. The court ruled unequivocally that an insurer must compensate for this inherent loss in value. While state laws vary, the precedent is powerful and has been cited nationwide. The critical factor, the at-fault party's property damage liability coverage, is what pays for this. You are making a claim against the insurance policy of the driver who hit you. Your own collision coverage may or may not have a diminished value provision. Check your policy. But the clear, universal path is through the at-fault driver's liability insurance. Their policy promised to pay for damages you suffer. The loss of resale value is a quantifiable damage. Act 3, the case study, a $4,200 fight. This is the standard first response, denial. The insurer will claim the repair restored the car completely. They will hope this is where you stop. For Mark, this is where his research began. Step 1, the independent appraisal. You cannot walk in with a gut feeling. You need a professional, third-party diminished value appraisal. A certified appraiser will calculate the loss using a recognized formula, often a variation of the 17C formula named from a Georgia court case, adapted for your state and vehicle. 1. Start with Nada Kelly Blue Book retail value, $42,000. 2. Apply a 10% damage cap. Max loss is $4,200. 3. Apply a damage modifier based on severity. 4. Apply a mileage modifier. High mileage reduces the claim. Mark's appraisal came to $3,950. The appraiser provided a detailed 8-page report citing market data, vehicle history report analytics, and the legal basis for the claim. This report is your primary weapon. Step 2. The Market Evidence Dossier. Arm yourself with real-world proof. Find listings for your exact car in your area with a clean history. Then, find listings with an accident reported. The price differential is visceral, undeniable evidence of your loss. Compile these screenshots. Act 4. The Battle Plan. The Demand Package. You do not negotiate this over the phone. You send a formal, professional diminished value demand package to the at-fault driver's insurance company, addressed to the adjuster handling the property damage claim. The demand letter framework, to whom it may concern, this letter constitutes a formal demand for compensation for the inherent diminished value of the above-referenced vehicle, which was damaged in a collision caused by your insured on 08112023. Enclosed, please find 1. A comprehensive diminished value appraisal report conducted by Mickle, a certified automotive appraiser. 2. Supporting market evidence demonstrating the significant value differential between vehicles with a clean history and those with an accident report. The principle of indemnity requires that you restore our client to the financial position held prior to the loss. As the attached evidence demonstrates, a residual economic loss remains despite quality repairs. We therefore demand payment in the amount of $3,950 to settle this distinct element of the claim. We expect a response within 15 business days. All legal rights are reserved. Certified mail is non-negotiable. It creates a legal paper trail and signals serious intent. Now you wait the negotiation. Their first offer will be low, often called a goodwill or nuisance value payment. This is a test. Your response is cordial but firm. You refer back to the independent appraisal. You restate your number. The pivotal phrase to use is, the appraisal report establishes the credible, market-based value of the loss. We are prepared to submit this report as evidence in a court of law if a fair settlement cannot be reached. The result: collecting the second check. After 2 rounds of negotiation, Mark settled for $3,600. Combined with the $11,300 repair check, he recovered $14,900 from the at-fault party's insurance for a single accident. The second check is real. This process works best on cars that are less than 5 to 6 years old, in good pre-accident condition, have sustained moderate to severe damage, especially structural, frame, are from brands with high resale value: Toyota, Lexus, Honda, Mercedes, etc. For a 10-year-old car with high mileage, the diminished value may be negligible. The newer and more valuable the car, the larger the claim. Your action plan? If you've been in an accident that wasn't your fault, your path is clear. 1. Complete the repairs. Use the at-fault party's insurance. Get your car perfectly fixed. 2. Gather documents. Get copies of the police report, the final repair invoice, and the initial property damage settlement letter. 3. Secure an appraisal. Invest $300, $500 in a certified diminished value appraisal from a reputable company. This is your foundational evidence. 4. Build your demand package. Write the letter. Include the appraisal and market evidence. 5. Send and negotiate. Send via certified mail. Negotiate from your appraised value, not their lowball offer. Be prepared to mention small claims court as a final, credible step. You paid for a car that held a certain value. Someone else's negligence took that value away. The law provides a path to reclaim it. It requires effort. It requires patience. But it turns the hidden, silent loss you've been carrying into a line item on a check with your name on it. They fixed your car. They didn't fix its history.